Welcome to the deep dive. Ever wondered how you can, really trust an organization is doing what it says it's doing? Not just with money, but following all the laws, contracts, the whole shebang?
That's a huge question, right?
Absolutely. Well, today, we're pulling back the curtain on something absolutely key to that trust, something that often gets hidden behind technical jargon, compliance reporting. So our mission today, let's crack this open. We're going to untangle the different kinds of reports they use to prove they're playing fair. We want to understand what each report really tells you and basically equip you, our listeners, with the know-how to read between the lines.
So you can decide how much faith to put in those claims.
Exactly. Consider this your shortcut to being genuinely clued in about whether an organization is actually following the rules.
Yeah.
Okay, let's unpack this. So to kick us off, just basically, what is compliance reporting? And why should anyone outside of, say, an accounting office even care?
Yeah, fantastic question. And honestly, it underpins our trust in pretty much any entity. Public companies, nonprofits, government agencies, you name it. Compliance reporting is, well, it's essentially an organization showing its homework, proving it's meeting specific requirements. And what's fascinating here is how these reports adapt. They fit different situations, each serving a distinct need for transparency and, oversight. Generally, you see this popping up in three main scenarios.
Okay, three scenarios. Lay them out for us.
Right. So the first one happens when an auditor is already knee-deep in a company's financial statements. While they're doing that audit, they might also be asked to check on compliance with specific contracts or regulations.
So it's kind of a bonus check alongside the main financial inspection.
Sort of, yeah. That's a good way to put it. Then, second, there's a much broader category. It stands alone. Here, a professional, a practitioner, is hired specifically just to report on whether an entity is complying with certain laws or rules. Or, sometimes, they even assess how well the internal systems are designed to make sure compliance happens. We call these attestation engagements.
Attestation engagements.
You got it.
And the third.
And the third scenario is super important for any organization getting federal money. Think universities, many nonprofits. In these cases, an auditor combines checking on compliance and checking the internal controls over that compliance. It's all part of what's called a single audit engagement.
Okay, especially key when federal dollars are involved.
Exactly. So why does all this matter to you, the listener? Well, it boils down to accountability. It's about building trust. It gives you confidence that organizations are operating within the rules, not just financially, but across the board, keeping their promises, meeting obligations.
That makes perfect sense. Different lenses for getting peace of mind, basically. Let's really zoom in on that first type you mentioned, the one that often goes hand in hand with the financial audit. What are the specific conditions for that one, and what's the main takeaway for us?
Great question. So for this first type, where compliance reporting is sort of tacked onto the financial audit, there's a hard rule. The auditor must have already done the financial statement audit. They can't just drop in only for the compliance part without that financial groundwork.
Okay, prerequisite.
Definitely. And the absolute key concept here, the thing to really get, is negative assurance.
Negative assurance. That sounds less than positive.
Well, yeah, it can sound a bit underwhelming, but it's very specific. It's a statement from the auditor that basically says, listen, during our financial audit, nothing jumped out at us that made us think the entity failed to comply with whatever rules they were looking at.
Okay.
So the real insight here for you is understanding what that means. It's like a doctor running standard tests and saying, well, we didn't find any signs of major illness. So it's good news, like no red flags popped up.
Exactly. An absence of red flags based on the work they were already doing.
Yeah.
But, and this is crucial, it's not a guarantee. It's not a definitive, this company is perfectly compliant certificate.
Because they weren't doing an exhaustive check just for compliance in this case.
Precisely. It means they didn't discover non-compliance, not that they can guarantee there isn't any.
That distinction is incredibly important. So if it's only negative assurance, what allows an auditor to even give that kind of statement? Must be some rules, right? Guardrails.
You're spot on. There are definitely guardrails. Three key conditions have to be met. First, simple enough, they can't have actually found any instances of non-compliance. If they found problems, they got to report them.
Intense.
Second, the main financial statements themselves must have gotten either an unmodified opinion, that's the clean bill of health, or maybe a qualified opinion. A qualified opinion means there are some specific disclosed issues, but overall the statements are still generally reliable.
And third, the specific rules or requirements they're giving negative assurance on, maybe clauses in a loan agreement, must have already been looked at as part of the main financial statement audit procedures.
So no extra work specifically for compliance here, it just came up during the normal audit.
That's the gist of it. Now, what happens if they do find non-compliance?
Yeah, what then?
Well, their report clearly has to describe those issues. And here's a really crucial point for you. If the main financial statements themselves got a really bad opinion, like an adverse opinion, meaning they're fundamentally flawed, or a disclaimer of opinion, meaning the auditor couldn't even form an opinion.
Okay, big problems with the financials.
Huge problems. In that situation, this attached compliance report can only be issued if there are identified instances of noncompliance.
Well, wait, so if the financials are a wreck, they can only issue the compliance report if it also shows problems.
Pretty much. It's like saying, if the main house is condemned, we can't give you a report saying the plumbing looks okay unless we also point out the leaky pipes we found. You can't offer any kind of comfort on compliance if the financials are that unreliable.
That really drives home how specific this type is. Totally dependent on the financial audit's outcome.
Exactly. And it's always in writing. Sometimes it's a separate report. Sometimes it's just included as a section within the main audit report.
Okay, so that covers the piggyback compliance report, the one tied to the financials. Now, what happens when you need a compliance check that stands completely on its own? One specifically designed just to answer that question. Are they compliant? That sounds like your second category. Attestation engagements. You mentioned SSAE.
Spot on. Attestation engagements, yes, governed by the SSAE standard statements on standards for attestation engagements. These are much more direct about compliance, and they generally come in two main flavors. First, you have compliance with specified requirements. Pretty straightforward name, right? It asks, is the entity actually following a specific set of rules? Could be laws, regulations, contract terms, grant conditions.
Just checking if they did what they were supposed to do.
Yep. And second, there's internal control over compliance. This one goes a bit deeper. It asks, are the entity's systems and procedures designed effectively to ensure compliance happens consistently?
So not just did they comply, but do they have the systems to keep complying?
Exactly. Think of it like a restaurant health inspection. Compliance with specified requirements is like asking, did the restaurant pass its inspection today? Internal control over compliance is more like asking, does the restaurant have solid systems, daily checklists, temperature logs, staff training to keep passing inspections tomorrow, next week, next year?
That's a great analogy. Makes it much clearer.
Now, there's a really important caveat here for you, the listener. An SSAE report, an attestation report, it does not provide a legal determination of compliance.
Oh, interesting. So it's not like a court ruling.
Okay. Not at all. It's the practitioner's professional opinion or findings based on their procedures. It can be incredibly useful evidence for lawyers or regulators making legal determinations, but it doesn't replace a legal judgment itself.
That distinction is absolutely crucial. Good to know. So how do these professionals actually do these attestation jobs? You mentioned different levels of depth.
Yes, exactly. For these attestation engagements focused purely on compliance, practitioners generally use one of two approaches: agreed upon procedures or examination engagements. And it's worth noting, a review engagement, which you sometimes see in financial reporting, offering limited assurance that's not permitted for compliance attestation.
Okay, no review. So agreed upon procedures or examination. Let's unpack agreed upon procedures first. The name itself suggests a very specific scope, right? What does agreed upon mean here?
It means exactly what it sounds like. In an agreed-upon procedures engagement, the practitioner performs only those specific tasks, those specific procedures that have been explicitly agreed to beforehand by the parties who will actually use the report.
So it's like a custom job, highly tailored.
Incredibly tailored. The practitioner isn't deciding the scope or what needs checking. They're basically executing a preset shopping list of procedures that the users requested.
Okay, a shopping list approach. What needs to be in place for them to even do that?
Good question. Two key conditions must be met. First, the responsible party, usually management, has to formally accept responsibility for their own compliance and for their internal controls over compliance. They own it.
Makes sense. Accountability first.
Yeah. And second, that same management must have already done their own evaluation of the entity's compliance or its internal controls before the practitioner comes in.
So management has to do their homework first.
Yes. The practitioner's objective in this case is quite narrow. It's simply to perform the agreed-upon steps and report the specific findings. That's it. They don't go beyond what was on that list.
Okay, so they do the specific checks requested and report back exactly what they found. What does this mean for you, the user reading this report? What level of confidence or assurance are you actually getting?
This is a critical point to grasp. With agreed-upon procedures, you essentially get no assurance, zero, zilch,
No assurance. Why is that?
because the practitioner isn't providing an opinion or any kind of conclusion that says, based on our work, we think the entity is compliant or isn't compliant. They're just giving you factual findings tied only to the specific procedures they performed. Like, we checked these 10 invoices for signature approval and 8 had them.
So it's up to the reader to decide what those findings mean.
Entirely. It's up to you, the user, to take those very specific, isolated findings and make your own judgment about the overall compliance picture. Because the practitioner only did what was on the agreed list, they haven't done enough work to form or give any broader opinion or assurance on compliance itself.
Got it. It's like the detective analogy you used. They only followed 3 specific clues, reported what they found, but didn't solve the crime.
Exactly that. They give you the puzzle pieces they were asked to find, but they don't put the puzzle together for you.
Okay, that's very clear.
Hmm.
So if you do want more assurance, if you want the practitioner to actually give their professional opinion, their best judgment based on a thorough look, then you'd move up to the next type, examination engagements. Let's explore those.
Precisely. Examination engagements are a significant step up, a much deeper dive. The main objective here is for the practitioner to express an actual opinion on whether the entity complied with the specified requirements.
An opinion. Okay, that sounds more substantial.
It is. And to give that opinion, they need to gather enough solid evidence to limit what we call attestation risk to an appropriately low level.
Attestation risk. The risk of getting the opinion wrong.
Basically, yes. They
Yeah.
need to do enough work to be confident their opinion is correct.
And are there prerequisites here too, like with agreed upon procedures?
Yes, similar conditions apply. Management has to accept responsibility for compliance and the effectiveness of internal controls. Management also needs to have performed its own evaluation of compliance. And, very importantly, there must be sufficient evidence available, either already existing or something the practitioner can develop, to actually support management's evaluation and ultimately the practitioner's opinion.
Can't form an opinion out of thin air. Need the proof.
Exactly. You need a solid evidential basis.
So what's the assurance level here? If agreed upon procedures is no assurance, what's the pass key for an examination?
The pass key, as the study materials often call it for an examination, is reasonable assurance.
Reasonable assurance. What does that mean in practice? High confidence.
Yes, it signifies a high level of certainty, but, and this is important, it's not absolute certainty. It's not a 100% guarantee.
Why not absolute?
Well, think about it like a doctor's diagnosis after expensive tests. They can be reasonably sure, highly confident based on the evidence, but there's always, inherent limitations. Maybe a condition is undetectable or evidence is hidden. So reasonable assurance means the risk of the opinion being materially wrong is low, but not zero. It's a high level of confidence, the highest typically provided in these types of engagements.
Got it. High, but not perfect. Makes sense. You mentioned materiality earlier. How does that play into an examination? Is it just about big dollar amounts?
Great question. Materiality in a compliance examination is actually more nuanced than just dollars and cents. While financial impact can be a factor, it's often more about the nature of the requirement itself. Some rules, maybe related to safety or environmental regulations, might have very little direct financial impact if broken, but the noncompliance itself could be considered highly material by regulators or the public.
So context matters hugely.
Absolutely. It also considers things like how often noncompliance happens, even if each instance is small, and fundamentally what the users of the regulators, funders, the board actually need to know, what impacts their decisions. That's what drives materiality here.
Okay, so it's about significance and impact in the context of the rules and the users. So when an auditor or practitioner is doing one of these full examination engagements, what's actually involved? What are they doing behind the scenes?
It's a pretty rigorous process, as you'd expect, for providing reasonable assurance. They have several key requirements. First, they absolutely have to perform a risk assessment.
Figuring out where the problems are most likely to hide.
Exactly. Where's the highest risk of material noncompliance? Then, based on that assessment, they design specific procedures to respond to those identified risks. Testing controls, performing detailed checks. They also have to determine if there are any sort of supplementary audit requirements mandated by specific laws, regulations, or contracts that go beyond the standard procedures.
Okay, check for extra rules.
Right. A really crucial step is obtaining written representations from management. We should definitely talk more about that.
We will. What else?
Oh, obviously, they prepare the final report expressing their opinion, And critically, they have to prepare and maintain thorough documentation.
Ah, yes, the required documentation.
Mhm.
What exactly goes into that? Is it just like their notes?
Oh, it's much more formal and extensive than just notes. It's the complete evidence trail that supports their opinion. It has to include details of their risk assessment, what they considered, how they rated risks. It needs to document all the procedures they performed, both to test the effectiveness of the company's internal controls over compliance and the results of those tests,
Okay.
and then the specific procedures they use to directly test compliance itself and what those tests found. It also has to document how they decided on materiality levels and how they addressed any special requirements. It's the whole story laid out.
Wow, that sounds comprehensive. Now, you mentioned getting written representations from management. That sounds important. What's the role of management in this examination process? Are they just sort of observed?
Absolutely not. Management's role is active and critical, and it gets formalized in what's called the representation letter. This is a non-negotiable part of the examination.
Representation letter, what's in it?
It's basically a formal document where management puts specific statements in writing, taking direct responsibility for key aspects of compliance. It's about clear accountability right from the top.
So what are they stating? What are they signing off on?
They explicitly state that they are responsible for the entity actually complying with the specified requirements. They also state they're responsible for having effective internal controls over compliance.
Owning both compliance and the system for it.
Yes. They also confirm in writing that they have performed their own evaluation of the entity's compliance. And crucially, they state they have disclosed to the practitioner all known instances of non-compliance.
So they have to fess up to anything they know about.
They do. They also have to confirm they've made all relevant records and documentation available to the practitioner, no holding back. They even need to provide their interpretation of any compliance requirements that might be subjective or unclear.
Okay, so clarity on fuzzy rules too.
Yep. And they have to disclose any communications they've received from regulators about possible noncompliance and even any known noncompliance that happened after the period covered by the examination but before the report is issued.
Wow. That's a lot of responsibilities squarely on management's shoulders. It really sounds like a cornerstone of the whole process.
It absolutely is. Without that rep letter, the practitioner usually can't issue an opinion. It formalizes management's accountability.
Okay, that makes total sense. Shifting gears just slightly, let's circle back to risk. You mentioned attestation risk of noncompliance earlier in the context of examinations. Can you break that down for us? What is it really?
Sure, attestation risk in this context is essentially the risk that the practitioner messes up. It's the risk they issue an inappropriate opinion, typically, giving a clean opinion when there is actually material noncompliance they should have caught.
The risk of getting it wrong.
Exactly. And just like in a financial statement audit, auditors think about this risk as having three components. Understanding these helps them plan their work strategically.
Okay, what are the three components?
First, there's inherent risk of noncompliance. This is the susceptibility of a particular compliance requirement to material noncompliance, assuming there are no related internal controls.
So how likely is this rule to be broken just by its nature?
Precisely. Is it complex? Does it change often? Is it subjective? Those things increase inherent risk. This risk just exists, the auditor assesses it, but they can't change it.
Yeah, what's number two?
Second is control risk of noncompliance. This is the risk that a material noncompliance could occur, but it won't be prevented or detected and corrected on a timely basis by the entity's own internal control system.
So this is about how good the company's own safety nets are.
Exactly. How effective are their systems at catching problems related to this requirement? Like inherent risk, this risk also exists independently of the audit. The auditor assesses it. If controls seem strong, they might rely on them more.
Okay, inherent risk, control risk. What's the third piece?
The third piece is detection risk of noncompliance. This is the risk that the procedures performed by the auditor will not detect material noncompliance that actually exists and hasn't been caught by the internal controls.
Ah, so this is the part the auditor influences.
This is the crucial one they control. Unlike inherent and control risk, which they only assess, detection risk is managed by the auditor through the nature, timing, and extent of the procedures they perform.
So if the inherent risk or control risk seems high,
Then the auditor needs to set detection risk low. That means doing more work, more rigorous testing, to reduce the chance that their procedures miss something important.
so they adjust their own workload based on the other risks.
That's exactly right. It's all connected in the audit risk model. Basically, the overall attestation risk, which they want to keep low, equals the risk of material noncompliance, which is inherent risk times control risk multiplied by detection risk. So they assess the first two and then adjust the third, their own work, to achieve that low overall risk target. It's how they strategically plan the examination to be effective and efficient.
So it really is a careful balancing act for the auditor, assessing the situation, assessing the company's systems, and then designing their own work to manage their own risk of missing something crucial.
Couldn't have said it better myself.
Wow. This has been such a thorough deep dive. We've gone from the broad idea of compliance reporting through the different types linked to financial audits versus standalone attestations. We've covered agreed upon procedures giving no assurance, examinations providing reasonable assurance, the critical role of management representations, and now this underlying framework of risk.
Absolutely. And I think the biggest takeaway here for you, the listener, is really internalizing these distinctions. Understanding them fundamentally changes how you can look at these reports. You can evaluate them more critically. You can understand the process behind the report, not just the conclusion. It's not just about an organization saying, yep, we're compliant, check the
Right.
box.
It's about how they got to say that.
Exactly. It's about understanding the robustness of their systems, the level of scrutiny applied, and the degree of accountability involved. Knowing how a report was formed tells you so much about how much weight you can actually put on its conclusions.
That really is the key insight, isn't it? It empowers you to ask better questions. So here's a final thought for everyone listening. The next time you encounter a report talking about an organization's compliance, pause for a second. Consider not just what they're claiming to be compliant with, but how that compliance was actually assessed. Was it negative assurance tagged onto a financial audit? Was it agreed upon procedures with no assurance? Or was it a full examination providing reasonable assurance? What level of assurance would you want for something that matters to you? Your investments, your data privacy, your trust.
A really important question to ponder.
Thank you so much for walking us through all of that today. It's been incredibly insightful.
My pleasure. It's crucial stuff.
Absolutely. So keep learning, keep questioning, and we'll see you next time on The Deep Dive.